And welcome to the Retire Early, Retire Now podcast. I'm your host, Hunter Kelly, owner of Palm Valley Wealth Management. And today we will be talking with Danny White of 212 Benefits about offering health insurance to your employees. So if you're a business owner, you're thinking about offering health insurance to employees, this would be a great listen, great starting point to go about offering those benefits. So great conversation with Danny today. We get into what we should think about as we start off with small companies and moving on to more customized plans in those larger company roles. So give it a listen. As a reminder, we are recording and putting this on YouTube now. So go to YouTube, subscribe to my channel, like the video, and share this with a friend that maybe owns a company and could offer benefits or maybe shopping benefits for their employees. So I hope you enjoy. Great conversation with Danny. And as always, I appreciate him coming on, but enjoy the listen. But anyway, so Danny White's back.
All right.
Yeah, talking about health insurance.
Yep. Part 2 or 3.
Part 2B.
Yeah, there you go. Let's go.
Yeah, we had some technical difficulty on my end when we started recording last week. I didn't actually record, so we're back. So this is actually lucky for you avid listeners. You'll get this one on a Thursday, so you get an extra episode this week.
There you go.
So we talked about contributing pre-tax versus Roth on Tuesday, and now we're going to have Danny White talking about health insurance. So if you're a business owner, we're going to do it from that perspective. And then next week we'll talk about those Roth conversions, like I mentioned on Tuesday. But just kind of a background. I know you've been on the podcast a couple times now, but tell us about 212 Benefits and how you help from the business owner's perspective, and we'll go from there.
Yeah, so like you said, Danny White, 212 Benefits, we're a local agency, and so what we do is we help business owners implement and manage their employee benefits packages. So that might be their health insurance, their dental insurance, their vision insurance, disability, and much more. So that includes, think Aflac or there's some other carriers, but you got your critical illness policies or your cancer policies. So all of those types of insurance create a benefits package, and we're kind of the middleman between business owners and the insurance carriers themselves. So we're kind of advocating for these business owners, kind of walking them through the steps of getting these policies in place.
Yep. And so if I'm a small business owner, for those that don't know, if you have less than 50 employees, you don't necessarily have to offer anything. So if I'm one of those types of employers and maybe I have some extra cash flow where I either want to reward my employees or maybe it's a way to start to recruit some new employees, where do I even start to go about finding health insurance plans to be able to offer to my employees?
Yeah, so obviously, working with a broker is step number one, because they're going to know the ins and outs. They're going to know the carriers are going to probably have your best luck with as far as rates, as far as the network in your area. I assume probably most of the listeners are Florida, Northeast Florida.
Yep.
So, obviously you probably are aware of Florida Blue, United Healthcare, Aetna, Cigna. It's kind of your big players, so to speak, in the area. And so just kind of quoting and figuring out what's the most affordable and what's going to fit the needs of your employees. But it is quite that simple. I mean, it's gathering very basic information on the employees you have. It's a list of them. And, we submit that to the carriers and we get some numbers. And so through some paperwork, we get it installed.
Yep. And so outside of the number of employees that the insurance company is looking at, what else is the insurance company looking at as far as how they're going to price out your group?
Yeah, so the biggest thing in the small market is going to be your age. And, if we don't have to get into the weeds necessarily, but if you have over 10 employees, they'll take an average of all of your employees' age, and they're going to spit out rates as far as tiered. It'll be employee only, employee plus spouse is a separate rate, employee plus children is a third rate, and then employee plus family, which would be a spouse and children, that's a fourth rate. And so those four are four different premiums every month. The other would be age banded, they call it, and that's based on your individual age. So they'll look at age, but they'll also look at, depending on the insurance products, they'll look at your history. So, there's some software. Again, this is all to put it lightly.
Yeah.
There's a master kind of software that all these different carriers can look to that has some of your health information and your history. And so they kind of use that and leverage that to, assess risk and how much they think that you're going to cost them in claims data.
So it can almost be like getting underwritten for some sort of other insurance, like life insurance,
Correct.
disability
Yep.
insurance.
Yeah,
but
I mean, it's
from a group
quite literally
standpoint.
underwriting.
Yeah. Good. And so once that's determined, let's say you sit down with the business owner and you lay out Florida Blue, United Healthcare, whatever. At that point, once the business owner decides what plans that they want, or carrier for that matter, what are they on the hook for? How does that start to affect their bottom line, and what do they have to contribute toward the employee?
Yeah, so once they decide what carrier and what plans they want to offer for the health insurance, it'll be important to note that as an employer, you're responsible for a minimum of 50% of the employee only, kind of going back to that tiered structure I was referring to, 50% of the employee only portion on the cheapest plan you offer.
Mm-hmm.
And so depending on how many employees you have, you can offer 2 plans, you can offer 3 different insurance plans with different deductibles and max out-of-pockets. But whatever the cheapest plan is you offer, half of the employee-only portion is the bare minimum. If you want to do more, you can, whether it's 75%, you cover 100% of the employee's portion. You can do a flat dollar amount per month. Whatever contribution structure you want, you can set up. And again, this is all on a pre-tax basis.
Yep. So, one, that'd be a good way to get a deduction, and then 2, you're offering that health insurance. And so, while I didn't do much of it at my old employer, I'd been like helping with another advisor on a couple of these cases where he came in and did the health insurance, and I got to do some financial education and stuff like that. So oftentimes, and you probably see this a lot, maybe the business owner has some extra cash flow and they'll fork up half of the lowest plan but offer a higher tier plan to say that, hey, we're offering you something, but I can't necessarily give you the Cadillac deal right away, which is a good starting point for those small business owners that want to kind of dip their toes in, but don't necessarily want to be on the hook for thousands of dollars a month per employee.
I mean, yeah. So again, that 50% of the cheapest plan, that's still really helping the employee.
Yep.
That's why it's called a benefit, right? I mean, if you get a health insurance policy through the marketplace, maybe it's $500 a month, and then you go through your employer, maybe there's a plan that's better quality, lower deductible, and it's $800 a month, but they're required to cover 50%. So you're only on the hook for $400. So you compare your individual marketplace to this.
Yeah, you save $100
better
bucks
quality
and maybe
plan.
you have a plan.
Yeah, exactly. And you're saving money still. So even that 50% can make a huge difference. So it definitely is a good way to dip your toe in, starting with the bare minimum. And it's not uncommon to see. And even kind of taking a step further, if you really want to dip your toe in as an employer of, offering some benefits, forget about the health insurance to start. Maybe it's just starting with dental and vision and some of those what we call ancillary or supplemental policies. Those can be offered and you can pay for it as the employer, and it won't be as much. It'll be maybe a dental policy is $20 to $35 a month. Vision is less than $10 a month. And so you can offer that and pay for it. That can be voluntary and you don't pay a dime, but you're offering it at least. So there's different ways to kind of dip your toe in. And then from there, as you grow, you start adding different lines of coverage, increasing contributions, and really bolstering the package.
Yep. And so once the business owner, I'm going to test my memory on here. Once the business owner has been offering, let's say, plans and wants to kind of level up a little bit, maybe the business is growing. Those plans that we're talking about right now are kind of cookie cutter, and they're called fully insured plans, right? So now what is the next step from, I've been in kind of this cookie cutter. I don't really have a lot of negotiating power. I'm kind of over that 50 employee threshold. I have a lot of cash flow. What are some next steps to maybe help more tailor my insurance to my employees, but also help on the business side as well?
Yeah, so I guess that 50-50 threshold where the employer contributes 50, that will never go away.
Yep.
That'll always be the case. But, kind of quote unquote leveling up, why would you want to look at changing up how you're doing it? And that's to save money. All right. Everyone wants the best quality coverage for the lowest cost possible. Who doesn't want that?
Yeah, that's like wanting the most possible return with the least amount of risk, right?
Yeah, right.
Exactly. That's
Exactly.
what everybody
Same
wants in my
thing.
business.
Yep. But, it's tough in health insurance because every year you're going to get an increase. Very seldom do you see a business owner get a decrease or even a flat, we call it, which is 0% increase on their premiums every year. Average is 8 to 10% per year, right? I mean, that's probably a little bit, we're about on pace with the S&P 500 and some of the major indicators. But, yeah, so kind of leveling up, so to speak. Why would you do that? To lower your increases. Take a little bit more control of your premiums every year and get access to claims data. That's the driver is claims data. And so, like you said, that's the fully insured model is where it's cookie cutter. I like to say you're renting your insurance. You're paying that premium every month. And it doesn't matter how much you use your insurance or not, you're not seeing that money back.
Yeah,
it's
and
profit.
Not to take away from what you do, but in those scenarios, you necessarily can't add a lot of value in the sense of, hey, I can go get you the best price.
Correct.
Because anybody that comes in that has access to those markets is going to get the same quote for XYZ company with
Correct.
25 employees.
Yeah, you're not hurting my feelings. I'll say it myself. If you're a business owner and you got a broker or a consultant that comes to you and says they're going to quote and save you some money, I mean, maybe they will find a plan that's cheaper, but it's not because of them. It's quite literally because the carrier quoted it. But yeah, so in the small market, very cookie cutter, not much you can do, no claims data, you're going to see increases. That's the renting the insurance, the fully insured model. The next step is called level funding. And it's kind of a hybrid of fully insured and the opposite end of the spectrum being self-funding. Large corporations, or not even corporations necessarily, but 500 plus employee groups, they can truly self-fund. They can pay for claims out of their own pocket without bankrupting their company. Small businesses want to take on a little bit more risk potentially, so that way they can contain costs and a la carte pick some of their benefits to where it's not so cookie cutter, and they get the data. But it's tough because if you have 30 employees, one crazy claim is really going to hurt you if you're paying for everything yourself, all the claims. So this level funding product in the middle is self-funding on training wheels. So, about, let's say, if your premium per month as a group is $5,000, about 40% of it, we'll say, goes towards, let's call it a claims funded bucket. And so that would be $2,000 a month. The other 60%, those are fixed costs. Those are going to be administrative fees. So that's profit for whatever carrier, keeping the lights on at their facilities, paying their employees. Broker commission, right? So obviously, we don't work for free, so that's built into there. And then the third thing is stop loss premium, which I'll get to in a second. But that's about 60%. So $3,000 goes towards that side. So month over month, obviously you're going about your daily life. You're using your insurance. Let's say as a group with 20 employees, it's a super healthy couple months, right? No one's really using their insurance too much. You're going to see money stay in that bucket because let's say on month one, again, you have $2,000 go into it, $1,000 in claims is spent. So you're left with $1,000 in that bucket, all right? It was a super healthy month. Month two, same thing, super healthy month. Let's say it's $1,000 worth of claims as a whole. Another $1,000 comes out, but again, $2,000 went in. So now you're up $2,000 in the bucket. That trend continues after 12 months. If you're sitting on a $10,000 surplus, you get that money back as an employer. And that's basically unspent premium. You kind of paid into it with your premium, but it wasn't used to pay for claims because it wasn't needed. You get that money back. If in the opposite direction, let's say it's a really unhealthy year and your employees were using their insurance a lot, you're never going to be on the hook for more than what's in that claims bucket, that 40%, because in that 60%, you were paying that stop loss insurance. And so that stop loss insurance is basically reinsurance, or you're insuring your insurance.
Yep.
So you'll never owe any more. And, obviously you'll have a price to pay, but it's going to be in the form of probably your renewal rates. You'll probably see a hefty increase if your utilization's super high.
Yep.
And so it's a little bit, more creative, and you have the potential to get some money back. And so you might ask, like, how do you track your claims and whatnot? Well, they give you a report every month. So, in the fully insured, which is that renting model, you don't get access to claims data. In the state of Florida, I should say. There are certain states, they have favorable state laws. In Florida, you go to a carrier and you're like, hey, Florida Blue or United Healthcare, whoever, we want to see our claims data. They'll tell you no, which is silly because you're paying, for your insurance every month, and it's yours.
Yep.
It's your data. But yeah, the level funding, it doesn't matter if you're small or large group, you get access to your data. So you'll see, 32% of claims this month went towards prescriptions, and 12% went towards the emergency room.
So let me ask you this. So once you get that data, does that change the plan year to year on where you're funding certain, because you're talking about these different buckets, right?
Yeah.
And so if I know I have a lot of hospitalizations or medicine or whatever it is, am I funding different buckets because of that? Or like how does that work?
Yeah, so it's all in the same bucket. The 40% premium you're paying goes into just the same account, and that's where all the claims are being funded from. But with the data, again, there's tips and tricks you can use to try to mitigate some of those costs. And so the data is really just acting as a way, as an alert, like, hey, just a heads up, this is where you're spending. If you want to cut back, this is where you need to cut back.
So it's a way for them to kind of prevent some of those costs coming in. So we know we're getting a lot of prescription drug costs or what have you, then maybe we can shop out a better, more cost-effective solution to what we've been paying, given whatever insurance plan I currently have, right?
Right. And so, with level funding in the small market, again, it's not super flexible, but it's not as cookie cutter. So with that data, if you're taking a name brand drug, maybe there's a generic version out there that, you can take instead. It'll save you money as a copay.
Yep.
It'll save the company money in that claims bucket, right? So it's a win-win. They're getting treated for what they need. They're saving money. The employer is saving money.
So hypothetically, like a blood pressure medicine, would the employers be able to see that? Obviously, because of HIPAA, they wouldn't say, oh, Danny, the employee, is taking the blood pressure medicine. But they know that $10,000 came from this blood pressure medicine. Can we find a generic for that one?
Correct.
Right?
That's exactly it. So they'll look at the data. If they're seeing 60% of their total monthly claims dollars are going towards a single prescription, let's try to address that prescription if possible. You don't know who it is. And if you're a small company and you have that family feel, you might know who. But you don't call it out. Maybe it's just an educational session with everybody. It's an hour-long session, just kind of tips and tricks.
Here's how we're going to cut costs.
Exactly.
so that instead of using all our bucket of insurance money, we can return it back in and maybe we get a bonus, right?
And that's the thing is trying to, and that's the hardest part, is kind of incentivizing employees to actually care. Because at the end of the day, I can sit here as a benefits consultant and I'm passionate about it. I love it and I want to talk about it.
But maybe I'm not.
Correct.
Or Johnny that's doing the plumbing's not.
I was going to say, any blue collar company or really any company, if you have a construction worker, their day to day has nothing to do with insurance. It's materials and construction. They're not focused on insurance.
I mean, I think a lot of people have to kind of go through this, but I have to remind myself, like, yes, individuals care about their situation, but sometimes I care a little bit more than they do, because it's just not my profession. It's what I've chosen to do. I enjoy doing it. And a lot of times clients know that they have to get it done. They don't necessarily want to get it done, and that's why they're hiring me. So sometimes it's pulling teeth, but they mean well. And so kind of the same situation, like the employer knows it's good for them because they're going to save money for the business, and the business can grow, or they can give bonuses or whatever, but it's getting that employee on board to kind of buy into that.
Yeah, that's definitely the hard part. And money talks to an extent.
Yep.
So, you can try to incentivize your employees by having them, be educated on the fact that, you could save money by doing this instead of this.
Yep.
Or you could save money by going here instead of going here for
Yep.
this treatment.
Yep.
And that only goes so far even. You'd think, the opportunity to save a couple $1,000s by going to this facility versus this facility would move the needle. Even then, sometimes we see it doesn't.
Yeah. Inertia.
yeah, right.
Inertia.
So, yeah, it's definitely it can get tricky because you want to get the buy-in, but sometimes they just don't.
Yep. And so let's hop into the next level. So
Yeah.
I'm growing. Maybe I've been on this level funding for a handful of years. I have some good data, and I really want to up my, or I guess take on or fund more of my risk.
Mm-hmm.
And so what are some scenarios or solutions that employers can start looking at now that they've kind of grown and gotten into an area where they can start taking on some of that risk from a insurance perspective?
Yeah, so I would say self-funding, as I've mentioned a few times now, but that's kind of a broad term. There's different ways to self-fund. And I guess the next step past level funding would be what's called a captive. And so there's a couple layers of protection. So, it's self-funding in a true sense, but there's still some backing. So you have you as the employer, you're on the hook, you have skin in the game.
Yep.
But behind you, you have a captive. They're on the hook for some, and they have some skin in the game to arrange. And then beyond that, anything above, let's say, $1 million claim, you have a third-party kind of reinsurer as taking on that third layer of risk. So there's multiple layers of risk where everybody is responsible for their segment, their dollar amount, and anything beyond that, they're not on the hook. So still ways to kind of spread risk, but you do take more on, and you have the opportunity to a la carte pick your benefits. So these fully insured products, these level funded products, for the most part, fully insured for sure, but most of the part for level funding, they're the quote-unquote BUCAs. They're BUCA is the acronym. Blue Cross, United, Cigna, Aetna. There's probably a few others in there, but they're the large national carriers that everyone knows. And you don't really see it and you don't really feel it when you're on their insurance plans, but they're handling the pharmacy benefit management, the PBM. They're handling the third-party administration, the TPA. They're controlling the plan designs. They're doing everything. And that's all built into your premium that you pay a month, right? And so when you're renting your insurance in that fully insured model, let's say it's $500 a month, 100 of that $500 per month could be funding the PBM that United Healthcare is using. It's all bundled in. With self-funding, you are basically unbundling, or you are extrapolating all the different vendors that are put together in a fully insured model, and you are choosing who you want to use. So you can, if you want, use a completely different TPA as you were when you were fully insured. It's a completely third party. They might be a privately held company. They don't have the shareholders to appease. There's no conflicting interests. The PBM, the pharmacy benefit manager, again, third party vendor. Maybe it's a privately held company where they don't have shareholders to appease, no conflicting interests. So you can a la carte pick the vendors and create your benefits plan and your health insurance plan from scratch. It creates a lot more cost containment. It allows you to take control.
To me, it allows for that customization, but just thinking from the business owner side, seems like a lot more work, right? So like who helps coordinate all that? Where do I even go to find these pharmacy managers and stuff like that? So is it somebody that would have to be hired in-house? Is it someone like 212? Explain that process on like how you would go about helping the employer create this new type of plan.
Yeah, so this self-funding through a captive as a new type of plan, it's best suited for employers that have about 50 or more employees, and you need a benefits champion, someone in-house. Obviously 212 Benefits, we're a consultant. We're going to be there every step of the way. We're going to support you. We act as an extension of your business. But at the end of the day, somebody within your organization needs to be bought in and be a champion of this process because there is more legwork.
Yep.
You see the fruits of your labor, right? Because you're containing costs and you're going to lower your premiums, but it does take some work. So, having someone to take that on as well as using us, and then typically the captive themselves, they end up helping a good bit in the process. So, those three work together to make it work.
Okay. And so I would imagine it would be somebody in HR, whatever type of title you want to give them. So are they reaching out to these different captives and doing this legwork, or is that where 212 kind of comes in?
Yeah,
and there's a lot of communication back and forth between that HR employee and 212, or HR and the captive? Like, how does that work?
Yeah, so typically, again, kind of in the fully insured model where we're the middleman, same thing.
Yep.
So 212 Benefits acts as the middleman between the captive and the employer. HR tends to wear that hat, but we also see the CFO.
Yep.
Because once you get to 50 and above, there's typically a CFO or something equivalent.
Of course.
So they end up being involved as well because there is a lot more financials that go into it. You basically set your own premiums to an extent where you try not to overcharge your employees, but you do need to make sure you're taking enough
you want to have
premium
enough cash.
so you have cash to pay for all these claims. So I almost think of it like federal tax returns. Like, after a year of being in a captive, if you basically quote unquote overcharged your employees, you have to give some money back.
Yep.
Or you undercharge, you might have to take more. You don't want to do that. So kind of like federal tax returns, the closer you are to zero, the better, right?
Yep.
So
course.
Same kind of thing there.
Yep. Ooh, I would not want to be a CFO calculating that. That sounds like
a lot of calculations go into it.
Yeah.
And that's where the data comes in, and that's where it's super important to see.
Yeah, I have a good buddy that works for Florida Blue. That's he's an actuary by trade. He's in management now, but I just think about those guys and gals that do that type of work for any type of insurance, whether it be health insurance, life insurance, like coming up with those premiums. Because I don't know how much you know about long-term care, but back in the 90s, early 2000s, they came out with these long-term care policies, right? And they were very fruitful, and you pay these premiums and you get all this benefit and all this. Well, 10 years later, they realized that they underprojected the premiums that they needed, and now they're obviously raising rates. And honestly, traditional long-term care at this point doesn't really exist unless you really want to pay a hefty premium. And so I think about that for any insurance. It's like, I don't know how you create these models to well above my pay grade, I guess, to price these things out. And I'm sure there's standards and things of that nature based off the size and what other types of groups have done and age classification and all that, but still would not want to be responsible for that. Well, good. Anything else you want to add before we get out of here? I think that was a good kind of starter episode for those who think they want to do insurance for their employees. We didn't really get into ancillary, but that could be a good start. So again, ancillary being dental, vision, disability insurance. Think about Aflac and Colonial Life. They do kind of like the cancer policy, short-term disability, things of that nature. Would be a good benefit to add voluntarily if you don't necessarily have the cash flow right away. But if you're growing like crazy, you have extra cash flow, it's a good way to recruit your employees. So that's why I think health insurance is good. And to be honest, you're doing right by your employees, getting them health insurance when they probably need it the most, whether that's preventative care or reactive care to whatever need they have. But anything else you want to add, Danny?
Yeah, I mean, I'd love to come on this every week and talk about health insurance, but Hunter's got other stuff he's got to talk about. So I'll actually direct you. I recently started a new series called Daily Dose with Danny. It's it says Daily Dose, but right now it's a weekly episode. It's anywhere from 3 to 5 minutes on LinkedIn and YouTube. anything and everything healthcare and health insurance related. It might be talking about the major players involved, the flow of money. It might be talking about compliance or even a Q&A session, or maybe it's doing some case studies with current clients or prospects. So it's a whole gambit of healthcare and health insurance topics, and again, short videos. So if you want to check those out, maybe Hunter can put the YouTube link or anything on.
Watch the first episode. Very easy to understand. It was just the basics of what health insurance is and how it works. And I think you just did one on HSA. I've not had a chance to watch it because I think it came out today as we're recording. So, no, very informative, and he's more technologically advanced because he's using graphics and all kinds of things. So check that out. And Danny, you're welcome anytime to talk about healthcare. So
all right.
I guess we'll see you next time.
Thank you very much.
Let me do a disclosure. This podcast is for educational purposes only. It's not meant to be financial, insurance, or tax advice. Please seek a financial professional when thinking about your own situation, and do not make decisions solely based on this podcast. Please seek help and keep Palm Valley Wealth Management in mind when making those considerations.